Morning, everybody. April 17th. That is third Friday for those who are not in the know. And I hope you're having a great start to your Friday. We're kicking off. It is options expiration day. That is obviously one of the great days of the quarter. We'll see, or forgive me, of the month. We will continue to dig deeper each day into opportunities. And that's kind of what I'm here to talk to you about this morning. One of the key things that we're going to be focusing on as we move forward is how do we improve this show? How do we make this unique? How do we make things different? And that's what I'm going to start with this morning. Key thing here is this is a new show. Okay. So off the bat, a little bit of, people asking me questions, thinking about what we want to do, what we want to accomplish. This is not going to be, a reaction to the 24-hour news cycle. You can get that push notification. You can get it from CNBC. You want to get stuff from Twitter, fine, go for it, right? That's not what we're going to do over 30 minutes. I keep watching these shows. I don't want to name names. You don't need a Goldman note. You don't need a breaking in a cryon. You don't need three guys in suits arguing about what the Fed is thinking. What you really need is somebody to take you underneath the headlines, the plumbing, the flows, the structure, the mechanics that are moving prices, not the narrative that's stapled on top of things. Because the reality is, as we do this and we talk about what's kind of happened over the last month and a half, it's just a knee-jerk reaction constantly. And it's frustrating because, that's not what I think I aim to do. It's just that we've been caught in this narrative. So let's take it back to the original concept, the original take, right? 5 parts, the tape, what moved and what the headline says versus what's happening. The big idea, a big actionable thesis per show, not a vibe, not a feeling, this is an idea. It is a trade. It is research. It is a structural edge. Then risk plus macro. What can break all of this? We have to talk about every trade because we know that it has 2 sides. And if you show only one of them and not show something else and how what can break down, that's not really a show. That's more of a sales pitch than anything else. The big lesson, I want to take one concept that can make you a better investor, a better trader, a better person. Options, flows, structure, risk management, things that increase your probability of success. And of course, because we need a little bit of humor or else you might cry, the most absurd thing in finance that we can find. It could be each day. It can also be each week. But this is bringing back an oldie but a goodie, one of my favorite concepts, which was called off the rails. So we'll talk about this. This is about education, entertainment, actionable elements. That's the show. The narrative is the costume. The plumbing is the body. Let's get into it. 19 slides, and we start with the Friday open. So it is third Friday, April options expiration, and that means billions of dollars, equity, index, futures options contracts will expire today. Gamma exposure will be getting repriced. Dealers who were pitting the market near strike prices all week are about to let go of the wheel. After OPEX, the gamma cushion can disappear. And that means next week could be a little bit more volatile. So keep that in your back pocket for anything that we talk about today. S&P futures are up about 0.2%. Dow futures currently up 35 basis points. NASDAQ up about 0.1. This is the third straight week of 3% plus gains on the S&P 500. The NASDAQ has been green for 12 straight sessions. We have not seen that since 2017. WTI crude, which is the U.S. benchmark, is trading at $87 to $88 a barrel. It's down about 4% for the week. Brent crude is at 96.16, down 3.2%. That's the headline number. But the headline doesn't tell you is that physical Brent, dated Brent, the actual price that refiners pay for real barrels of oil right now is trading for $116. That's a $22 gap between futures prices and the physical price. And that gap still is the Strait of Hormuz. And that gap is the real world cost of war. I remind you, the economy is not the market, and the market is not the economy. And the mechanics of this market have largely driven this rally, which we'll get to in a moment. The dollar-yen differential right now is at about 159.3. That's a full handle from yesterday's 158. Gold's near all up, pushing back up to around 4,800. That's very important to note. We want to see where this can move on that spot side if we're going to start to approach near that all-time high. We did push to 5,500, but remember, that was where all the speculative elements were recently. That was back around January 30th where there was that disconnection in ETFs. So we want to actually quote this. It's really trading near a logical high, right? Near a place where, gold was moving. It moved to 5,000. That was basically where the ATH was. Then we had this explosion to the upside. And then all of a sudden, it absolutely cratered, falling on around January 30th when all of that leverage released. So I want people to think and benchmark this 4,800 to 4,900, even 5,000, really for what it is, which is having the supply and demand balance in place, and really that acting more like what the real all-time high should be, and not that speculative all-time high that did not have the broader story behind it, which is ongoing concerns around the dollar, ongoing bifurcation internationally. These things matter. And I want you to think a little bit differently about what all-time high might mean, because speculative all-time highs are really not doing us any service. In fact, what can happen very often is, because silver right now trading at 80, its all-time high is 120, but that was driven by speculative excess. That was a flush out. And the fundamental price, the ongoing trend of silver, is still clearly locked in place from that rally that began in early 2024, late 2023. That doesn't do us any service, because part of us might think, well, what happens if the price pulls back from here? It's already collapsed from 120 down to 80. Could it go from 80 down to 60? Don't be thinking that way. Be thinking about this floor, this continued floor. Use the 200-day moving average, the 100-day moving average, and break the chain of the thinking that because gold was at 5,500, that's really what the all-time high figure is. I don't want to think that way. I want to think a little bit differently than how most people are assessing this environment. To talk about headlines this morning, and this is a critical thing, right? There's 5 major headlines. There's 5 major narratives that you will see in financial news. A lot of this is knee-jerk narrative. It's not really capturing the underlying plumbing and mechanics of the market. You're going to see articles written with, well, stocks are rising on Iranian optimism. Says who, right? That's just us looking as journalists for a story to tell. The reality is the markets have been rising because CTAs are, buying $86 billion and have $70 billion more loaded in the system right now. Machines don't care about headlines. That's why this matters. They're following rules. So where do we look? Well, we want to be paying attention to one of the things that we discuss on a regular basis, and that's volume-weighted average price. So volume-weighted average price, we go over to TradingView for this. When you look at the way that this is set up, here is the SPX, and here is this core line in the sand, that blue line, that is your VWAP. But if we go back a month and we go to the lows of the month and we anchor our volume weighted average price to that low, that is the line from that point. If it is anchored to that point, and we're going to go through this with people who are members of Money Printer Pro, if it is anchored to this point, that is going to be the line that institutions are defending. It is something that is important to recognize. It's not just about volume weighted average price, but you can see volume weighted average price kind of grinding higher. It's just grinding higher. That's very important. So when we look at this and when we assess this, we want to recognize that if the S&P 500 grinds higher on lower volume with no news catalysts, it's likely CTAs buying it. Don't fight that. Other type of headline that we look at on a regular basis and we see constantly is this idea of AI momentum is lifting stocks. Okay. The real story might actually be that a lot of these AI stocks have been helpfully driven by some of the plumbing in the financial sector. And I pointed out in our email last night that you had a $100 billion drawdown in the general account starting March 31st. Interesting timing. Now, I'm not saying that that's what caused it, but what I am stating is that when you take away stress on the margins, that's important. It's got a little bit of a mini PE component to it with no press conference, but really it's a reminder that liquidity is the fuel and the technical signals were the match. The TGA drawdown can be gasoline in this environment. It doesn't mean that it is what drove it. It just simply means that it took away a lot of forced sellers. And in an environment like this, sometimes getting rid of the sellers is more important than just triggering the buyers. Remember, the purpose of the market is to sell. And when forced selling happens, well, things can get pretty odd and difficult if there aren't buyers to match that. We'll hear that the markets are rallying on earnings strength, but are we talking about gamma flipping and a short squeeze of 9 to 17%? Do we talk about positioning, not fundamentals that drive velocity? What Goldman has noted about T plus 1 month up to 2.2% when you start to see CTAs moving in this direction. We'll hear people say Netflix slumped on guidance. Well, the real story is that Hastings stepping down and there's a Q2 miss. Why does it matter? Is this a first mega cap crack, and does it spread or is it contained? So what do we look for? Well, we look for Netflix and whether or not the contagion associated with it impacts FANGs. And we keep a close eye on the tools that we continually note are really important to watch in this market, regardless of what is happening. The very first things that we should be looking at each day. Where is the FNGD? Is the FNGD rising or falling? Is the FNGD, which has consistently told us time and time again, if there is stress in leverage, that maybe we want to be cautious. We saw this the entire duration on the backside of 2026. We saw it with our negative momentum move that happened at the end of January. We saw it with the larger sell-off at the end of March. And this is the 1% pattern that we are constantly focusing on: a dip, a pop, and a dump in the larger FANG stocks. This is the leverage, and we watch the leverage because the leverage tells us if the big boys are walking away. Final thing to always focus on, and this is important, right? The idea that the ceasefire raises hopes. That's the headline. The real story is around Hormuz. The real story is around oil companies warning President Trump. The real world pain, what really matters, is that gap between that spot price of 116 and futures at 96. That matters. So where do we look? Pay attention to KBC. Pay attention to the fact, the fact that it said, if no traffic by June, this is a different turn. It's very clear that this entire situation is going to come down to whether or not that gap closes and how it impacts economies, how it impacts a lot more than just the headline itself. This stuff, you have to dig deeper into it, and you have to know exactly where to look. Ugh, that coffee is terrible, but it's working. Here is your big idea for Friday. All right. So the title card, again, this is the big idea. This is the 5 minutes of the show where I think it's important to pay the most attention to. This is where we're going to go deeper than a headline and ask, what is this really telling us? And the key story today comes out of Goldman. $86 billion. That's what CTAs, commodity trading advisors, the systemic trend following funds, bought last week. This is a top 5 all-time move. So Goldman's Brian Garrett comes out. He publishes this data yesterday. And let me walk you through why this is so important. Going into March 31st, CTAs were short about $47 billion in this market. Short going into the end of the quarter. They were positioned for the market to actually keep falling. And then momentum starts to shift. This is what we are always looking at. We're looking at oversold conditions. We're looking for the possibility of a squeeze higher. We're looking for our poor momentum reading to turn positive. We're looking for our academic reading of momentum to turn positive. Okay. The NFCI started to loosen the National Financial Conditions Index. With that, we saw technical signals start to change, and the machines did what they're programmed to do. They started to unwind their shorts and they started to go long. And the speed of that reversal, $86 billion in 5 sessions, was a top 5 in all-time history. And again, this does coincidentally or matter of factly, can we use that? let's use that. Matter of factly, I'm going to put that on a t-shirt, coincided with the Treasury drawdown, which is around 10, 20, 200 billion at peak that started at the end of March. Now, that has moved back higher. But again, as we noted, the importance of this is that it impacts the margins. It impacts the ability of, that those four sellers to not have to do that. All of this is about plumbing. Now, here's what we don't get out of the primary news session. Goldman has this cohort modeled to purchase another $75 billion in the next 5 sessions. That's a big number, right? In a flat tape, if the tape goes up, they got to buy more. They're buyers in all scenarios. So these funds buy volume weighted average price style. Volume weighted average price. They buy a little bit of the day, every day, and spread it across the session, which is why it's very important to keep your eye on VWAP. And that is, again, over at TradingView. We talk about this. We have this on Money Printer Pro. We have it in our deep dive session. We can bring it down to 1 minute, but I'm going to use it here. So if we look at the SPX, you could see this line right here is your volume weighted average price. This is your first standard deviation, second standard deviation, third standard deviation. The focus and the buying typically aligns around here. And if that force buying is going to be coming in, that creates trading opportunities for investors who might be looking at some of these top tier names on the S&P 500, because what we're looking for explicitly is buying around that blue line. If that buying comes in and the pattern kicks up and there is a hard trigger on that, a few moving parts. First off, this sets up for buying call options on a day like today, where you buy at the money and you look for a continuation of price into the end of the day, moving higher. And once again, if you're buying at the money on a Friday, there's no time in the options, right? We don't have to worry about that. So we're really just setting stops right around here. In addition to that, look for buying down here in the third standard deviation, far away to the downside, because that is the expectation of VWAP is over time, the duration of the session, we're going to move back toward that line. It acts like a magnet for price. So we're looking for third or fourth standard deviation moves and an opportunity to step in and bid on the stock in case there is any sort of sell-off that starts the day. I'm always looking for stocks down here on a day like today, third or fourth standard deviation, touching this line and looking for a reversion back to this line. Effectively, what I prefer to do is buy at the money. So if in this situation, you see that the Amazon was down at 243.40, that means I'd be buying the 243 call, not speculating to the upside, simply looking to take a single or a double if we can get a move back up. Now, on top of this, the key thing that really matters, and I think is really kind of being left on the sideline, is the idea that it's like watching somebody eat a sandwich for 8 hours. It really is a boring process. So if you're a trader, good. This is something you should have on your screen. If you're not a trader, don't worry about it, but recognize that these are the tools in place. And if you're looking to buy equities, you should be looking at where we sit in those deviation bands, because if you're to the downside and you want to go long some of these stocks, you obviously would prefer to be able to buy it under VWAP, maybe a standard deviation away, because those spreads might be wide between each level of that volume weighted average price. And that can give you a little bit more alpha that you can generate buying $1 less than where volume weighted average price is. Look, remember yesterday and today, that slow, steady grind higher was basically no news catalyst, no breaking headline. That's CTA buying. And that's the sandwich. Easiest way to put it. The Bloomberg will run a cryon that says optimism. Charles Schwab's Liz Ann Saunders said something on CNBC last night that captures it kind of perfectly. She said, 11 days, we got to new all-time highs. There's nothing wrong with that. And I think we need to see more participation under the surface. She's right. The breadth is very narrow. Mega cap text is doing the heavy lifting. But what she's describing without naming it is a flow-driven rally. It's not a fundamental rally. And flow-driven rallies can persist a lot longer than people expect. Key thing to keep in mind, key thing to focus on are these key moving averages, 20-day moving average, 8-day EMA, looking for opportunities. Again, This can persist a little bit longer. But here's the thing, right? When we see buying this big, Goldman's data has given us a little bit of a playbook. In the T plus 1 month, the average S&P 500 return after episodes of accelerated buying like this is about 2.19%. And in T plus 3 months, the average is about 8.1%. So short-term digestion is followed by medium-term strength. And if you layer that on the fuel stack, the TGA drawdown injected 100 billion in reserves. Dealer gamma is at its widest spread on record. Short covering ripped the high short interest basket 9 to 17%. And now you have another 70 billion more in CTA buying that's being modeled. So these aren't opinions, these are structural flows. The risk here is interest rates. And Goldman has said on Goldman analysts have said on Bloomberg, we need rates relief to come in. The 10-year is at 4.30 right now. Oil is keeping the floor under yields. And if rates don't come down, then the flows can carry the market for a little while, but eventually fundamentals have to pick up the weight. And that's why it's going to be so critical to watch RSI, pay very close attention to what's happening with reversions. So 4 things to watch, right, on a day like today. S&P 500 behavior around volume weighted average price. And again, there's opportunity. If the SPX falls into that 4 standard deviation, that is where you can step in and buy the SPY wherever it sits at the money and look for a reversion to the upside. That grind, those kind of little tiny periods where there's a lot of questions, that creates opportunity. So if it grinds higher on lower volume, you're just seeing some buying in real time. Don't fight that. Secondly, we have to see what happens with Netflix. Does a major drop in Netflix, which is currently at the moment, Netflix is down 10%. Does a 10% move on the FANG stay contained? That's information. Third, we have bank earnings. Truist regions, fifth third. I get that wrong. Ally, State Street, all pre-bell, right? So the KRE is in focus, and that is the regional bank, right? Regional bank stocks have been really doing well in recent weeks, trading kind of range bound over the last 5. But over the last month, where that insider buying and really picked up, it's gone from about 62.50 up to about 68.80. So there's still questions, right, about what their exposure to consumers. It's very clear that the Federal Reserve did its job in helping to contain issues around reserves. Reserves look healthy, but the KRE we have to pay close attention to. And the final thing is Fed speak. So we have Daly, Barkin, and Waller. Then we enter the blackout period. So the question now is rates, and we're not going to have a lot more commentary moving forward or any clues from the Fed on what could come. So listen for any crack at all in the hawkish consensus. That's our idea. The machines bought 86 billion. There's 70 billion more loaded. There's opportunity in volume weighted average price. The risk is rates and oil, but the media is just going to call it optimism. Okay. So if we continue our conversation this morning and we move on to kind of what our next focus should be, it's really on the risk and the macro and what can break it. Flows are very powerful, but they're not invincible. And I just want to walk you through the other side. This is the risk, and this is my job. This is where my focus is. I'm playing defense, okay? So, yeah, it can be very confounding to me when all of a sudden a momentum rally happens because we've just come out of a very pessimistic period. Our signal went positive on April 7th. It has been ripping higher ever since. And, you know, we did note on April 6th on our Money Printer Pro headline, the bond market cracked, like, the move index just plunged. It's set up for that squeeze. That was the headline. And that move on the OILU, which I'm going to walk you through in a moment. Okay. So Netflix, we're down 10%. Q2 guidance miss. Reed Hastings is stepping down. The academic framework to this is very important. This is what's known as post-earnings announcement drift, PEAD. And it's one of the more documented anomalies in finance. Stocks that miss tend to underperform for 30 to 60 days. So the question is whether the CTA mechanical bid overrides that repricing for the broader market. So you have to watch the FANG peers. You have to look at Amazon, which is been great. You have to look at Google and Netflix. And again, all of those questions around CapEx spending and about borrowing money in order to ramp up their AI, spending. All of that is still relevant. It hasn't disappeared. It's just moved from the front page to page 8. So those risks still do persist, and we do have to make mention of them, because it can't just be blue skies every day. You have to be realistic about markets. And again, this is kind of game theory-esque. All right. Now, the overbought signal, 11 days from oversold to overbought. We've seen this happen time and time again. Only 1982 was faster. So Saunders is right. This does need some breadth to sustain. We need to see more stocks moving above their key moving averages. And one of the key places I want you to always go look at FinViz, and you can see very quickly what is the health of this market. Well, right now, 60% of stocks are above their 50-day moving average. About 50% are above their 200-day. Okay. You're seeing more stocks advancing than declining. You're seeing more health. That's good. But I will note, as we look over at our signal every morning, one of the key things that we are able to analyze is the fact that, well, at the end of the day, it is the largest stocks in the world that are driving this bus right now. And that is what this figure is really all about. It is about our ability to understand just how much is being driven by those larger numbers. So as you can see, we're plus 71 on our momentum reading. We were even a week, 10 days ago. So April 7th. All right. The cap weight, however, went positive around the 6th. And that's because those big, larger stocks are driving the bus, right? Because they have higher market cap, they have a higher weight. Therefore, their weight is lifting the market higher. And this is important because this goes back to what happened in 2021. In 2021, the S&P 500 burned much higher, but the bulk of stocks on the S&P 500 did nothing, and the Nat and the Russell was kind of choppy the entire year. That coincided with drawdowns in the TGA, by the way, the Treasury General account, which once again noted that this market loves capital. And when there is uncertainty, where does money flow? It flows heavily into the mega caps. It moves into these crowded stocks. So it's very important to keep your very close eye on the MAGs at all time. This is the MAG 7 ETF. And once again, we've seen a relationship in momentum between the 20-day moving average and the MAGs, largely, once again, because they are the bulk of the market. That is a heavy amount of weight in the S&P 500. That is where the leverage is. There's a lot of capital efficiency in these businesses as well, and significant passive flows. They are the framework of the financial system. All right, on top of this, though, I do want to just note we have a couple other things that we want to be cognizant about. Physical oil is very important, right? Dated Brent is at 116, futures at 96. We covered this. The IEA chief said, brace for significant price surges. The Bank of England's Breeden warning that war could trigger several market stresses at once, and KBC saying if no real traffic through Hormuz by June, well, the narrative shifts. Now, one of the big things that's happening right now, and I've talked about this extensively, is just that oil is cracking. And the big thing is the OIOU. And a couple of weeks ago, I said to readers in Money Printer Pro, and I've talked about this here, is it's important to always, if you are speculating on upstream oil and gas, the upstream is where the producers live, where the drillers live, that we were in a very comparable situation to 2023 when Russia went into Ukraine. So we squeezed higher on the OIOU. And once again, the OIOU, which I'm going to lay this out, this is an instrument that is 3 times leveraged crude oil exchange traded note. It tracks 3 times the daily return, largely of almost WTI crude futures, but it's really the selective index. So if you see a big drop in crude, you're probably going to see an even larger 3x multiple on that on the OIOU. Very important to keep this in mind. Now, why does all of this matter? It matters because CTAs and systemic funds, the same machines that bought $86 billion in equity, use these leverage products as momentum signals. I use it as a momentum signal. And when it breaks under these key moving averages, well, that's where you start to see Exxon and some of these other bigger names sell off. And if you need an example and just, what my warning was, this was the Putin period. And then in June of 2022, it was just risk off. Oil prices were still elevated. The war was still going on, but there was just a drop, just a huge sell-off. And in fact, this coincided with one of the largest hedge fund sell-offs that we had really ever seen. I think it was the largest hedge fund sell-off in 15 years. All right. Now, this is all very important information. It's all very critical to keep an eye on this because, once again, the entire concept, the entire story is the fact that Hormuz is still shut, but physical dated Brent, what refiners paying, that gap still exists. So why is the futures price dropping? It's dropping because of the deal hope trade. Markets are still pricing in the probability that Hormuz opens, and the markets are still worried that President Trump is going to send a tweet out that causes oil to drop significantly. People don't want to be on the other side of this. So the OILU, just as a reminder, leverage amplifies the flow signal. It works the same way that the SPXL works in equities, 3 times leverage, right? That's important. But a sustained decline in oil means that CT energy shorts start piling in, and that more selling begets more momentum. It becomes self-reinforcing. It's the same flow mechanics that we talked about in equities, because CTAs will buy. Well, it works in the reverse in energy. And if oil keeps falling, the machines push harder. So you want to be paying attention to if we get into a period here of oversold on the OILU. And that has historically coincided with short covering. So that's one of the next things we are looking for. We're looking for the OILU to dump down into an RSI somewhere in that 30 range. And then we are going to be willing to speculate to the upside on oil prices. All right, next up, I talked a little bit about this yesterday. This is the yen. 159 on the screen, one handle from the 160, one handle from intervention. The BOJ's UTA saying today that monetary conditions remain highly accommodative. That's central banker 4. We're not hiking. April rate hike bets have been unwound, and Citi says that if the BOJ holds, 160 will break and 160 will trigger intervention. If 160 breaks, Japan intervenes, the carry trade unwinds, treasury yields can spike, and repo markets can see stress. This can lead to forced banking responses. The BIS, once again, I wrote about this last year, proved the mechanisms. You want to watch the FXY for the yen, the TLT for the treasuries, and the MOVE index for bond volatility. If 160 prints, those 3 instruments can tell you that a chain reaction might be starting. Geopolitics. All right, real quick. On the deal board side, Lebanon ceasefire took effect at 5 p.m. yesterday. It appears to be holding, and Iran has agreed to almost everything Trump has said, including nuclear weapon language beyond 20 years. Next meeting is possibly this weekend. The friction is that Senator Graham says he's confident the ceasefire won't extend past next week. Gulf and European officials say that a real deal takes about 6 months. Hormuz is still shut. Physical oil is obviously still elevated. Trade the data on this one. Watch oil, watch Hormuz, watch whether traffic actually resumes. Headlines are the noise, and the traffic will be the flow. All right, it's time for Off the Rails. New segment every Friday at least. We're going to take the most absurd thing that's happening in finance all week and what it tells us about the market. And that brings us to our good friends at Allbird. San Francisco sneaker company, wool shoes, sustainable fashion, whatever that means. The kind of brand where the CEO probably had a chief empathy officer on speed dial. The IPO was in 2021 at a $4 billion valuation. By 2024, it was down 99%, less than $1. The stock was worth less than a latte at the cafe where the customers had meetings about brand alignment. This month, it sold for $39 million to American Exchange Group. And then, need you to let that sink in. This week, the AI pivot. Allbirds is becoming an AI cloud provider. GPU as a service. The company will be renamed New Bird AI. They're raising $150 million through convertible notes. And this is my favorite part. I want you to sit with this. They're removing the environmental conservation mission from their corporate charter. Fantastic. So, why does this matter? Well, it matters because this just shows you the ability of markets to shift on a dime and the ability for companies to shift on a dime. Alphaville did a great job mocking this. And as we talk a little bit more about it, God bless them, they wrote, we'd suggest running away as quickly as possible if anyone can suggest a suitable brand of footwear for the task. Stock is up 774% on a name change. A name change. That's it. They didn't build anything. They didn't ship anything. They changed the name of the door from Wool Shoes to AI Cloud Solutions, and the stock went up 700%. So if I rename my garage, Baldwin Aerospace, give me $100 million. When bankrupt shoe companies can 8x by adding AI to their name, it tells you where we are in the cycle. This is the 99.com in 2026. The AI trend is real, and TSMC proved that, but the froth is also real. So know the difference between the companies building the future and the shells that are riding the narrative. That is your framework for every AI stock that you look at from here. Wrapping up this Friday with our big lesson. This is Your Money, Your Edge. And today, I just want to just briefly note that you can get paid, right? This is the part of the show where I want to teach people something that matters, that makes you better at this. Not better at picking stocks, but better at managing your money, better at increasing your probability of success, because that's the game. It's not about being right. It's about being right more often than you're wrong and making sure the wins are bigger than the losses. So here's the setup. Relative strength index is overbought. We went from oversold to overbought in 11 days. It's options expiration day, third Friday, which means billions in options contracts are rolling off and gamma exposure is getting repriced as we talk about this. The historical playbook says short-term digestion. CTA buying supports the floor, but upside may be limited short-term. You own positions. You're sitting there. What do? Most people do one of two things. They sell everything because they're scared, or they do nothing and they hope. And both of these strategies technically are strategies, but they're bad ones, but they're strategies. A third option is to sell a covered call. And if you haven't done this before, that's fine. I'm going to explain it to you like I'm explaining someone at a dinner party who just asked me what I do for a living, and now they regret it. A covered call works like this. You own 100 shares of something, maybe Apple. You sell someone the right to buy those shares from you at a higher price by a certain date. And for that right, they pay you cash right now up front. That cash is called premium. That's income. That's yours no matter what happens. If the stock stays flat or goes down a little, you keep that premium. You just got paid to own something that you were going to own anyway. If the stock rips past the price you picked, you sell at that price, which is higher than where it is right now, and you keep the premium on top of that. The only thing you give up is the move above your strike price. You've capped your upside. So you're trading unlimited upside for guaranteed income, and that trade-off makes a lot of sense when the RSI is overbought and the historical playbook says we're probably going to digest before the next leg. So if you were to make this real and you had the SPY at 709, you own 100 shares. That's a 71 shares on $71,000 position. You sell one SPY, May 16th, 72 call for about $850 in premium. That's $850 on your pocket right now. If the SPY stays below 720 by May 16th, you keep the $850. That's 1.2% income for 30 days. Annualized, it's about 14%. On the S&P 500, for doing something really nothing except agreeing that you'd be happy to sell $11 higher than where you are right now, which is, by the way, what you would be. Scenario 2 is the SPY rips past 720. You sell at 720. That's 1,100 in capital gains plus the 850 in premium. So that's a 1950 total return. You shouldn't be crying about that. Scenario 3, the SPY drops. The premium offsets about 850 to the downside, and your effective cost basis drops from around 709 to 17.50. 709, 700 0.50. Forgive me. You're still exposed to the downside. That isn't a hedge, but you're exposed to 850 less of it. The framework's pretty simple. You pick stocks. You're happy to own the long term. You sell calls 5 to 10% above the current price. You choose 30 to 45 day expirations. That's a sweet spot for theta decay, which is a fancy way of saying the premium erodes fastest in the last month. You collect the premium, you repeat the monthly, and if you get a sign, congrats, you sold at a profit. You redeploy that capital. The goal isn't to predict, it's to increase your probability of success. And when RSI is hot and the market is stretched, getting paid to wait is how professionals handle that. And that's your lesson. We wrap up with catalysts in the close. Just a reminder, the bank earnings pre-bell, Truist, Regions, Fifth Third, Ally, State Street. We're going to get a financial check post UNH. Fed speak today from Daly, Barkin, Waller. Listen for any crack in the hawkish consensus. Netflix Contagion Watch. How is that going to be impacted? What are the CTA flows looking like? The dollar yen and the 159. Iran talking a possibility this weekend. Markets could gap up Monday. Plan accordingly. But I want to leave you with this. The machines bought $86 billion. They have $70 billion more loaded. The historical playbook says digest and then rip. The media says optimism. We're saying plumbing and, of course, the mechanics. But remember, a shoe company became an AI cloud provider and went up 700%, which is, let's be honest, the most 2026 sentence I've said out loud this year. If you're sitting on positions in RSA as hot, you've got calls that you can sell. You can be busy, get paid to wait. If you're waiting for oil to crack, understand the mechanics. OILU, CTA energy flows, the leverage amplifier. If the yen hits 160, you'll know what's coming because we told you. The narrative is the costume. The plumbing is the body. And I encourage you, as always, to trade the data, not the headline. And I hope you have a wonderful weekend. That will do it for us at our new version of the Market BRRR. Let us know what you think in the comments. I appreciate your feedback as always. And as always, stay positive.